Less volatile than I expected. I have to say, I've always wondered how the arithmetic was going to work. And I've always been concerned, having experienced 2008 as an example, about a fear-driven liquidity squeeze. The 2008 liquidity squeeze happened with our nation's balance sheet, at least our public balance sheet, in substantially better shape than it is today. And I'm afraid that if a liquidity crisis of that order of magnitude were to occur today, the ability that the Fed in particular would have to deal with it is much, much, much more constrained. As recently as 1981 or 1982, in the U.S., federal debt was about 30% of GDP. Now federal debt is about 130% of GDP. In 1982, the net present value of unfunded liabilities in the United States was about 1 times GDP. Now the ratio of unfunded liabilities to GDP is about 4 times. And I continue to be concerned about, first of all, the arithmetic around our reliance on the government. And I continue to be concerned about what happens in society if greed in financial markets turns into fear. I'm also concerned about the growing acrimony in the U.S. and other places. I'm concerned that people have been politicized enough that they believe that they're entitled to the fruits of other people's labor. I'm afraid that white people now feel like they're being crowded out of entitlement markets by black people. I feel like black people consider that whites have taken unfair advantage over time. I'm concerned about our concern about immigrants. I'm concerned about the rising tide of anti-Semitism. I think a lot of this has to do with politics. If people believe that they're entitled to the fruits of other people's labor, if they get crowded out of access to other people's labor, they blame the other people rather than the fact that they should have been self-reliant. And so I'm concerned about that. But, you know, I'm a 72-year-old curmudgeon, and I understand that some of it might just be myself. I've always been optimistic about my ability to thrive. I've been optimistic about many of my friends' ability to survive. Sometimes I thought they might need my help, and sometimes they have. And I should probably be more optimistic about society. You know, we've talked, Dunnigan, you and I, about the fact that Pareto's law says most people are good. There's only sort of 4% of the population that are programmed to be problem units. Maybe 1% of the population that are programmed to be really, truly hostile units, which means that, you know, we need to try to hang out with the 96% who are good people, maybe worry less about the 4. Sadly, too many of the 4 are elected officials. And, you know, that is, of course, problematic. You know, I remember, sorry to answer this ad nauseum, but
no, actually, you're going about where I was going to go in the end anyway, so you just keep going.
It's a very interesting question. I remember when I was about 16, cataloging all the woes that were in front of me to my grandfather, asking him, you know, what I thought I should do. You know, Vietnam, which I wasn't particularly interested in. Anybody who grew up in California, as I did, I was explaining all this litany of woes to him. My grandfather started laughing. He said, you know, son, my generation had some challenges too. We had World War I, which wasn't pretty. We went from World War I to the Great Depression, and we went from there to World War II, which ended with the atomic bomb. You're going to get through this. And if you keep your wits about you, you aren't going to just survive, you're going to thrive. And that was pretty good advice. And my belief, Dunnigan, is that your listeners, the sort of self-actualized people who understand that they need to take control of their own future, that they need to invest in their education, they're going to do just fine. But I got to say, I'm worried about the other ones. But not for me. You know, I mean, I live on a little island in rural Washington. The program trouble units couldn't find their way here. And if they did, they'd find a fairly well-schooled, fairly well-armed population. It wouldn't be a fertile place for them. But, you know, I'm a bit concerned for people who have been conditioned to believe that society's going to look after them. Recycle ratio, I should explain recycle ratio for the majority of your viewers who are not hip deep in natural resources. Recycle ratio refers to the amount of reserve and resource that a company can either buy or discover and build with the margin that they enjoy on 1 unit of production. So as an example, if an oil company enjoys a $30 margin on a barrel of oil, and if they are able to discover or buy $2 barrels of oil with that $30 margin, they're described as having a recycle ratio of 2 to 1. The margin that they enjoy relative to the cost to replace the unit that the margin came from is called the recycle ratio. Recycle ratio is easier to measure in the oil and gas business because the stats are larger, the time frames are longer, and in particular because your discovery well becomes a mine. It's in fact a better business than mining. But recycle ratio is absolutely critical in the mining business too. I would suggest to you that the reason that Agnico Eagle is the most valuable mining company in the world, despite being the third or fourth largest producer, is because both their margin and their recycle ratio, their ability to generate returns on capital employed, their ability to allocate capital well, and their ability to manage their business on a per-share basis rather than on an aggregate basis is the best of any major mining company that's an operating company. Certainly Franco-Nevada is better, and certainly Wheaton Precious is better, but note that they're royalty and streaming companies, not mining companies. Note, too, that they trade at much higher multiples.
You know, folks often ask me why I spend so much of my life worrying about unsustainable debt, about liquidity squeezes, about whether the market will still be there tomorrow to finance someone else's profligacy. And I have to laugh. Not because it's funny, but because it's tragically obvious. I've been around long enough to remember the calm before the storm in 2007. I've been around long enough to remember what it felt like in 1981, when Paul Volcker decided to finally tighten the screws. The difference between then and now? Arithmetic. Pure, simple, ugly arithmetic. Back in 1981, the US federal debt was roughly 30% of GDP. You could run an honest budget deficit, throw some bond auctions, and still have plenty of room before you got anywhere near the edge of the cliff. The net present value of our unfunded liabilities, things like Social Security, your Medicare, and all those IOUs we've written to ourselves to pay tomorrow's bills, was about 1 times GDP. Today, you're talking about direct federal debt of roughly 130% of GDP and unfunded liabilities that add up to more than 4 times GDP. It's frankly astonishing we're still walking around with any sense of complacency. If this were a household, the bank would have repossessed the house and sold the kids into indentured servitude a long time ago. The reason we get away with it, at least so far, is because we own the printing press. We issue debt in our own currency, and we've trained ourselves to believe that the Fed can always come to the rescue. Well, I'd suggest taking a hard look at the math. If we have another liquidity crisis of the magnitude we saw in 2008, and I believe we will, eventually, the Fed's ability to intervene is dramatically more constrained. In 2008, the bailout checks were written against a balance sheet that was still modest by today's standards. Today, every rescue operation prints more money against a vastly weaker balance sheet, eroding confidence, not just domestically, but globally. And confidence, my friends, is everything. Fiat money is trust. Trust that your neighbor will accept your dollars tomorrow. Trust that the Chinese manufacturer will ship your car parts and accept treasury bills in return. Trust that your grandkids' savings won't be vaporized by some future Fed maneuver. Once that trust is shaken, it doesn't come back easily. Now, that might all sound dire, but I'm not necessarily pessimistic. Certainly not about myself or most of you listening. You see, I've always had an optimistic view about my ability to survive, hell, even thrive, regardless of the macro. I invest in education first, then in tangible assets. I keep my wits about me, which is more than you can say for about 95% of the people who show up on CNBC every morning. And look, this is a people problem as much as it is a numbers problem. When greed in financial markets inevitably turns to fear, as it always does, the social fabric comes under strain. I'm worried about that part too. I'm worried that too many people have been conditioned to believe they are entitled to the fruits of someone else's labor. And when that promise inevitably fails, they'll look around for scapegoats rather than inward to their own lack of preparation. You see it already in the rising acrimony, racial resentments, anti-immigrant sentiment, anti-Semitism, you name it. Everyone's angry, but not enough people are taking real steps to become resilient. The irony is that these frustrations get aimed at each other, instead of the real culprit, which is decades of monetary policy and political cowardice that has systematically robbed savers and rewarded debtors. I joke that maybe only 4% of people are problem units by nature, but sadly, too many of those find their way into elected office. It's the Pareto principle in reverse. The small minority of the most meddlesome people find a lever to impact everyone else. Now, I learned a long time ago not to let that drive me into despair. I remember I was about 16. I had cataloged all these looming problems for my grandfather. The Vietnam draft, stagflation, civil unrest. I thought I was carrying the weight of the world on my young shoulders. He just laughed, said, "Son, we went through World War I, then the Great Depression, then World War II ending with atomic bombs. You'll be fine. Keep your wits about you, and you won't just survive, you'll thrive." That was pretty good advice then, and it's still good advice today. I genuinely believe that most of you listening right now are the kind of self-actualized people who will do just that. You'll take personal responsibility, you'll invest in learning, you'll save something real, and you'll protect yourselves from the fallout that's coming.
The truth is that all this time that they allegedly were manipulating the silver market, silver was going down all by itself. The US dollar was very strong in the period 1982 to 2022. And you didn't need to manipulate something that was falling all by itself. I'm not suggesting that there wasn't short-term manipulation in the market. There's short-term manipulations in all markets. Markets as large as the euro-dollar market and the U.S. Treasury market have been proven to be manipulated in the very, very, very short term. Once we began to lose control of the interest rate in 2022, surprise, surprise, the dollar weakened and gold and then silver got stronger. There will come a time when silver will be manipulated up. I remember the 1970s when the overnight raids in the silver market were long raids, not short raids. I remember that very, very, very well. The same players, I would suspect, would build very, very, very large and very long variegated futures positions and then pile into the physical market because the futures positions were leveraged so that the overnight boost in those days in the price of gold and silver would produce outsized gains in the physical market. The same technique that they used in the period 1982 to 2022 on the short side. No difference. The time will come again. Understand that the manipulators take markets in whichever way is the easiest to take it. They're completely agnostic. And when it is easier to manipulate precious metals markets up than down, that's what they'll do. When the natural direction of the markets is down, but the preponderance of punters is on the upside in futures markets, the manipulators happily fill the mooches. In their words, when it's easier to fill the mooches long, that's what they'll do. The shortage of physical silver could be prevented in the future. You may recall 1987, when the silver price shot up as a consequence of Warren Buffett announcing that he owned 20% of the world's above-ground supplies of silver. An interesting thing happened at that point in time. We didn't know how much physical silver was in India, but the price of silver doubled in US dollar terms, and the Indian rupee fell by half, which coincided with either a flood or a drought, I forget which, and the need that the Indian peasantry had to sell their silver, which was up fourfold in their terms, to feed their children. All of a sudden, supply came out of nowhere. The flow of silver, which had been from Dubai to India, reversed, was from India to Dubai. And we had more silver we could shake a stick at, of course. The people who were hurt by that blamed the manipulators, but the manipulators were really the Indian peasantry. Now let's get back to the base question. The silver manipulation works like this. The futures market trades some days 100 times, some days 200 times the amount of physical silver available for good delivery. Almost all of the contracts roll off worthless or are rolled over. Those are the two things that happen. Occasionally, the markets get unbalanced and syndicates of shorts go way short the silver market, borrow physical silver, which they blow into the market, take a loss on, and cover their shorts as the physical market, the tail wags the future market dog. Remember, too, that when some newsletter writers talk about a short squeeze, that's not the way futures markets work. What happens if there's a real imbalance in futures markets and there's a failure to deliver? We saw this in the tin market 2 years ago.
So let's continue this conversation by talking about where we are in the commodity cycle and how it links to all these broader risks we've been discussing. Because if you want to talk about surviving and thriving, you've got to start with reality. And the reality is that we're seeing perhaps the most spectacular disconnect between the fundamentals of real things, copper, silver, gold, oil, and the price action in the broader financial casino than at any time in my investing life. Look, take copper as an example. Copper inventories on the LME and COMEX are laughably tight. We're running at levels that historically have only preceded major price spikes. And that's not because the market's too hot right now. It's because it's been underinvested for a decade. Nobody wanted to finance a new copper mine when they could buy a stonk like Tesla and get 10x in 6 months. Meanwhile, governments around the world are telling us we're going to transition to electric everything, build a new green grid, install charging stations on every corner. That's all copper intensive. So when I hear people say, Rick, copper's too expensive now. It was $2.50 a few years ago, and now it's over $4.50. I laugh, not because it's funny, but because it misses the entire point. Price is what you pay. Value is what you get. If demand is locked in by policy, but supply is structurally constrained for a decade or more due to permitting delays and ESG headwinds, you tell me which direction the price goes. It's the same story in silver, only more dramatic. I talked earlier about recycle ratios. Well, consider the silver miner's predicament. Your average primary silver producer is mining ore that might grade 3 to 4 ounces per ton. That's thin soup compared to decades ago. The easy ounces are gone, and yet demand keeps rising, not just for jewelry or coins, but for industrial uses like photovoltaics. By the way, let me pause and riff on that for a second. I once quipped that the average politician thinks silver is just shiny. They don't realize it's a critical industrial metal, essential for solar panels, medical devices, water purification systems. You want to triple global solar deployment in the next decade? You'd better find more silver, or prices will do the work for you. Now, investors don't think this way. They think linearly. They say, well, silver's $37. It was $24 a year ago, so it's gone up too fast. They fail to realize that markets spend 80% of their time boring you to death and 20% of their time moving in such a way that makes up for all the boredom. When you look at the 1970s silver chart, what do you see? Long plateaus, sudden vertical moves. Same with the early 2000s gold bull market. The gains come in bursts, and that ties right back to human psychology. People always want to pile in after the move has happened. They want comfort. They want the crowd. They say, show me 3/4 of higher prices, then I'll buy. Well, that means you're showing up to the party after the drinks have been poured, the music's been playing for hours, and most of the dancing's already done. Meanwhile, the smart money, and yes, this is where I have to repeat myself, the smart money is already positioning. Central banks are buying gold hand over fist. Some reports, like the recent Goldman Sachs note, estimate China's been buying 10 times more gold than they publicly declare. Think about that for a moment. These are the insiders of the fiat system. When they start diversifying away from their own product into real money, maybe we should pay attention. But of course, the retail investor, he's still out there chasing meme stocks and crypto pumps. I'm not saying there isn't a place for speculation. Speculation is wonderful, if you understand what it is. It's betting on price movement, not on value. And for the few who are nimble and disciplined, it can be very rewarding. But it's not a substitute for building a resilient financial foundation. And that brings me to the other elephant in the room, social stability. Because ultimately, these financial discussions, interest rates, debt-to-GDP ratios, gold's recycle ratio, they all matter because they support or undermine the social contract. When people lose faith in money, they lose faith in the institutions that manage it. And when they lose faith in institutions, they start turning on each other. I've been watching the rise of populism across the developed world, whether it's in the US, Europe, or even Japan's growing nationalist undercurrents. Much of it comes back to ordinary people realizing, often subconsciously, that the promises made to them cannot be kept, that pensions will be paid in devalued money, that medical systems strained by aging populations can't deliver the care they expect. So they look for scapegoats. Sometimes it's immigrants, sometimes it's the wealthy, sometimes it's foreigners. History teaches us that once this dynamic takes hold, it rarely ends well. That's why I emphasize personal agency. It's why I still believe most people are good. But we also have to recognize that 4%, the professional troublemakers, the opportunistic demagogues, have always existed. They'll leverage every crisis for their own gain. So what do? You prepare. You don't rant on Twitter or X or whatever it's called now about how unfair the system is. You build your own personal redundancy. That might mean owning some farmland. It might mean living in a jurisdiction that respects property rights. It definitely means owning some real assets that can't be printed by central banks. I'll give you a funny example. A good friend of mine lives in Montana. He jokes that he sleeps better at night, not just because of his diversified portfolio, but because of his well-stocked freezer. He's got enough elk and bison in there to feed his family for a year. Now that might sound extreme to you, but it's just an extension of the same principle. Resilience, optionality, not relying on a fragile supply chain or fragile promises from fragile governments. People often say to me, "Rick, aren't you worried about the volatility in these mining stocks?" My answer is always the same. I'm terrified of owning nothing real. The volatility of a tangible asset, whether it's a producing gold mine or a producing oil field, is far preferable to the certainty of holding a fiat currency that's systematically destroyed by policy design. Let's pivot to another fun topic, ESG, environmental, social, governance, or as I sometimes like to joke at conferences, easy, sleazy, gravy, because that's what a lot of it is. Don't get me wrong, I absolutely believe we should be responsible stewards of the environment, but the way ESG is practiced today is mostly about virtue signaling. It often ends up punishing precisely the companies we most need to build the next generation infrastructure. Take copper again. You can't have an electric vehicle revolution without copper. You can't have solar panels without silver. You can't even have wind turbines without rare earths. Yet we make it harder and harder to permit these mines. We burden them with so many regulations that new supply simply doesn't come online fast enough. And then we wonder why prices explode, or why we end up dependent on supply chains run through politically unstable regions. That's why I say, if you're an investor with a long-term view, this is an opportunity, not a crisis. The world is systematically underinvesting in the very things it claims it wants more of. That creates inevitable scarcity. Scarcity is the mother's milk of price appreciation. Let me also talk about the difference between hope and strategy. Too many people think they're diversified because they own the S&P 500 plus maybe some tech ETFs and a couple of real estate REITs. That's not diversification. That's just concentration in different flavors of the same macro bet. Low interest rates forever and endless liquidity. Real diversification means holding assets that respond differently to monetary debasement, to credit stress, to geopolitical shocks. That's gold. That's silver. That's high-quality mines with long-life reserves. That's energy. That's farmland. And yes, that's cash. But not all in one currency, and certainly not all in one banking system. By the way, you might remember in 2023 when Signature Bank and Silicon Valley Bank imploded practically overnight. My firm onboarded about 4 years' worth of new clients in just 45 days because people suddenly realized that FDIC insurance was a fig leaf, and a pretty thin one. Most folks still think the bank is a safe place for large sums of cash. They forget that they're actually unsecured creditors of the bank. That becomes very clear very quickly in a panic. And here's where it gets interesting. When we had that mini crisis, gold jumped, silver jumped, and mining stocks absolutely ripped. We added thousands of accounts, many from people who'd previously thought precious metals were boring. That was just a tremor. Imagine the magnitude of the next quake. One last thought. I've been around this business for 50 years, and one thing I've learned is that markets don't care about your feelings. They care about supply and demand, about capital flows, about cash costs and recycle ratios. The investor who gets rich isn't the one who picks the perfect stock at the perfect time. It's the one who buys real assets when they're unloved, holds through the inevitable volatility, and reaps the rewards when everyone else finally panics into the trade.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.